Hey everyone, welcome back to the channel. Tensions between the United States and China are flaring up once again, this time, over trade and critical resources. What started as a dispute over technology and exports has now turned into a much broader economic standoff, one that could reshape global markets in the months ahead. Main story. The latest escalation began after China announced even tighter export restrictions on rare earth minerals. Those are the critical materials used in everything from electric vehicles and smartphones to advanced military systems. In response, the Trump administration said it plans to set price floors across multiple industries to counter what it calls market manipulation by China. And things didn't stop there. President Trump also announced a new round of 100% tariffs and even threatened to block imports of Chinese cooking oil, after Beijing halted purchases of American soybeans. He went a step further, posting that he's considering terminating business with China altogether, a move that would mark one of the most dramatic economic breakups between the world's two largest economies. Interview summary. U.S. Trade Representative Jamieson Greer joined the conversation, confirming that President Trump is expected to meet Chinese President Xi Jinping at the upcoming APEC summit on October 31. But he also made it clear, the U.S. is preparing for the possibility of a decoupling from China if things continue down this path. According to Greer, it's actually China that seems to be taking steps towards separation, trying to control global supply chains and dominate key industries. He explained that while the U.S. still hopes for a constructive trading relationship, China's actions, especially in restricting exports and manipulating supply, make that increasingly difficult. China's economic situation. Greer also commented on the Chinese economy itself, saying it's facing major structural challenges, including youth unemployment above 20%, and slowing growth due to weak real estate and infrastructure sectors. He questioned the credibility of China's official economic data, noting that Beijing has tightened control over what information it releases. Despite these struggles, China continues to hold enormous leverage, particularly in rare earth refining, which makes up about 70% of global supply. That gives Beijing significant control over industries that rely on advanced materials. U.S. Response and strategy. In response, the U.S. government has started to invest directly in domestic mining and refining. Recently, the U.S. made an equity investment in the Mountain Pass mine in California, and greenlit new infrastructure projects like Ambler Road in Alaska, aimed at accessing critical minerals. Private companies are also stepping in. J.P. Morgan, for example, announced a $1.5 trillion fund to boost American manufacturing in key sectors. Greer said this is part of a broader effort to de-risk and diversify from China's dominance in the supply chain. Trade and tariffs. The situation doesn't stop at minerals. China has recently imposed sanctions on several U.S.-linked companies involved in shipbuilding, while the U.S. has rolled out new port fees on foreign shipping vessels. According to Greer, these moves have been in the works for months, and Washington is trying to strike a balance, protecting domestic industries without sparking full-scale trade chaos. He added that the U.S. is crafting policies carefully, so that American shipbuilding and exports remain competitive, while minimizing price impacts on consumers. Legal challenges and next steps. Meanwhile, President Trump faces legal pushback over his tariff policies. A major Supreme Court case is scheduled for November 5, which could decide the future of the administration's authority to impose tariffs under emergency powers. Greer said the White House is confident it will win, but acknowledged that losing the case would be disastrous for the administration's trade strategy. Beyond China, trade talks are also ongoing with Canada and Mexico under the USMCA agreement. The U.S. currently maintains tariffs of around 35% on non-compliant Canadian goods, along with higher tariffs on steel, aluminum, and lumber. Greer said while the U.S. values its long-standing relationship with Canada, it must put America first to protect domestic production. Corporate reaction. American businesses, however, are worried. Some corporations say that stacked tariffs, multiple layers of import taxes, are driving up costs and slowing growth. Greer responded that the administration's goal isn't to hurt business, but to encourage domestic manufacturing and reduce the trade deficit. He noted that certain tariffs don't actually stack, meaning companies won't be taxed twice, but acknowledged that industries dependent on imports will need to adjust. Foreign investment and energy developments. Despite trade friction, the U.S. is still welcoming foreign investment, particularly new, greenfield, projects that create jobs and manufacturing hubs within the country. And there's even talk of reviving the Keystone XL pipeline project with Canada, following recent political shifts in Ottawa. Greer emphasized that energy cooperation, along with trade in agriculture, defense, and technology, will be key parts of the next phase of U.S.-Canada relations. Conclusion. So to sum it up, tensions between the U.S. and China are once again at a boiling point. From rare earth minerals to tariffs and shipbuilding, both nations are taking steps that could reshape the global economy. As the APEC summit approaches and new trade negotiations unfold, all eyes will be on how President Trump and President Xi navigate what's quickly becoming one of the most consequential economic standoffs in modern history.